Welcome back to the Ultimate Trading Podcast for beginner traders, where we're helping you unlock the secrets of successful trading and make smarter, more informed decisions in the markets. If you're looking to take your trading to the next level, you've come to the right place. Today, we're diving into financial statement analysis, which is one of the most crucial skills for any trader, especially those interested in stock trading or long-term investments. Now, you might be thinking, I'm not an accountant. Why should I care about balance sheets and income statements? Well, here's the thing, if you're making trades based on charts alone, you're only seeing part of the picture. Financial statements are like the story behind the chart. They give you the essential insights into a company's financial health, performance, and future prospects. If you want to make more informed and competent trading decisions, understanding these financial statements is non-negotiable. Let's start with the basics. What exactly are financial statements? Simply put, they are a collection of documents that provide a snapshot of a company's financial condition. They are typically released quarterly or annually and include things like the balance sheet, income statement, cash flow statement, and statement of shareholders' equity. These documents give you a deeper understanding of how a company is performing and, perhaps more importantly, whether or not it's a good investment opportunity. The first statement I want to talk about is the balance sheet. The balance sheet gives you a picture of a company's financial position at a specific point in time. Think of it like a financial snapshot that tells you what a company owns, its assets, what it owes, its liabilities, and what's left over, equity. By understanding these three components, you can assess how financially stable a company is. For example, a company might have lots of cash on hand and solid property investments, but if it's carrying an enormous amount of debt, it could be at risk. On the other hand, a company with little debt and strong equity may be in a better position to weather financial storms. This is key information for traders who are looking for financially stable companies. Next up, let's talk about the income statement, also known as the profit and loss statement. This document shows how well a company is performing over a set period, whether it's a month, quarter, or year. The income statement breaks down revenue, expenses, and profits. This is where you can spot a company's overall profitability. Take revenue, for example. Revenue is the money a company earns from selling its products or services. If a company's revenue is growing consistently, it could be a sign of good management and strong demand for its products. But it's not all about revenue. You also need to look at expenses, which include everything from the cost of goods sold to salaries and rent. Finally, the net income is what's left after all expenses are deducted. This is the bottom line. And it tells you whether the company is actually making a profit or running at a loss. Then, there's the cash flow statement, which tells you how much cash is coming in and going out of the business. Cash flow is crucial because even if a company is profitable on paper, if it's not generating enough cash to pay its bills, it could face trouble. There are three sections to the cash flow statement: operating activities, investing activities, and financing activities. Operating activities show cash generated from the company's core business. Investing activities show cash spent on or earned from investments, like buying new equipment. Financing activities show cash related to raising capital, such as issuing stock or borrowing money. The final statement we need to look at is the statement of shareholders' equity. This shows how the company's equity has changed over a given period, based on factors like retained earnings and stock issuance. Understanding this statement gives you insight into how the company is managing its profits, whether it's reinvesting them into the business or returning them to shareholders in the form of dividends. But here's the thing, just looking at these statements isn't enough. You need to know how to analyze them. That's where horizontal and vertical analysis come in. Horizontal analysis involves looking at financial data over multiple periods, so you can identify trends. For example, you can see if a company's revenue has been consistently increasing over the last few years or if it's been declining. Vertical analysis, on the other hand, involves looking at each line item as a percentage of a base figure. For instance, you might compare each expense in the income statement as a percentage of total revenue. This helps you understand the relative weight of different items. To really make sense of all this data, you also need to calculate some financial ratios. These ratios give you a quick way to assess a company's performance. For example, liquidity ratios like the current ratio tell you if a company has enough short-term assets to cover its short-term liabilities. Profitability ratios like the net margin show how efficiently a company is turning revenue into profit. And then you have leverage ratios, which tell you how much debt a company is using to finance its operations. Now, I want to share a real-world example to show you how all of this works in practice. Let's look at Apple Incorporated, one of the largest and most well-known tech companies in the world. By analyzing Apple's financial statements for the fiscal year ending in September 2021, we can get a clear picture of how the company is doing. Apple's balance sheet shows that it has a total of $351 billion in assets, including $62 billion in cash and $192 billion in non-current assets like property and equipment. In terms of liabilities, Apple owes $287 billion, but it's worth noting that a significant portion of this is long-term debt, which they can manage because of their strong cash flow. With $64 billion in equity, Apple is in a very strong financial position. Looking at the income statement, we can see that Apple generated $365 billion in revenue, an increase from $274 billion the previous year. Expenses totaled $265 billion, leaving Apple with a net income of $94 billion and a net margin of 25.7%. This shows that Apple is not only generating significant revenue but also doing a great job of converting that revenue into profit. When we look at Apple's cash flow statement, we see that the company generated $104 billion in cash from operating activities. It spent $10 billion on investing activities and used $99 billion for financing activities, including $14 billion in dividends and $87 billion in stock repurchases. This shows that Apple is not only generating cash but is also returning value to its shareholders through stock buybacks and dividends. Finally, a quick look at Apple's financial ratios shows that it has a solid current ratio of 1.08, indicating adequate liquidity. Its gross margin is 41.8%, and its debt-to-equity ratio is 4.48, which indicates that Apple uses a significant amount of debt, but given its strong cash flow, this is manageable. When we compare Apple's financials to other companies in the tech industry, it's clear that Apple is performing well above its peers in terms of profitability, cash flow, and asset management. Now, you might be wondering, how can I use this information in my own trading? The key takeaway here is that understanding and analyzing financial statements helps you make more informed decisions. If you're trading stocks, you can use this data to assess the health of a company before entering a position. By examining financial statements, you'll be able to identify strong companies with good growth potential and avoid those that might be struggling. I'd love to hear from you now. Do you currently analyze financial statements when making trading decisions? Or is it something you've never really thought about? Let me know in the comments down below, and I'll be sure to respond. In conclusion, studying financial statements is absolutely essential for understanding the true value of a company. It allows you to assess everything from profitability and cash flow to debt levels and equity. By incorporating this analysis into your trading strategy, you'll have a deeper understanding of the companies you're trading and increase your chances of making smarter, more profitable decisions. Thanks for listening, and remember, the more you know about the companies you trade, the better equipped you'll be to navigate the markets with confidence. Happy trading!
Thank you for listening to the 101 Trading Tips in the Ultimate Trading Podcast, brought to you by bellsforex.com AudioWorks. We hope this episode gave you insights, perspective, and practical ideas to strengthen your trading mindset and improve your decision-making. Stay disciplined, keep learning, and remember, every trade is a step toward building your edge. If you found value in today's episode, don't forget to like, subscribe, and turn on notifications. Sharing the podcast with fellow traders helps us grow and bring even more free trading education to the community. Visit us anytime at bellsforex.com for resources, guides, and tools to support your trading journey. Until next time, trade smart, stay disciplined, and keep building your edge. Happy trading.